Just make sure the audio is fully set up and then we're good to go. Yeah, can you still hear me, Juan?
I can, yeah.
Okay, perfect. So I thought we'd start with, and again, it is a very broad question, I guess, but I would like you, because I think you explain it in an eloquent way that traders aren't necessarily used to. Most traders hear risk and they go, well, I risk X amount to get X amount of reward. And it's kind of like a very base level of what risk really is. So I'd like to hear your thoughts, and you can go into as much depth on this as you want. I want to hear your thoughts on what is risk and why it's important.
Yeah, that's quite a question, isn't it? Uh, yeah, I'm actually looking up. I mean, I was when we talked about preparing this session, I was looking up some old slides of a webinar that I did back in the day, and which we actually recorded on YouTube. And if people want to look it up, it's kind of me. It's value at risk explained
Let me
on
grab the
YouTube,
link.
and for quite some. Can you hear me?
Yes, come here.
Yeah. Okay. Did you guys miss everything I just said, or
No. We heard you.
there?
Heard you, yeah.
Okay. Yeah. All right. So it was kind of, for a while, it was like the most popular video in Darwinex. So I guess this is an interesting topic. But before we go into the what, I think I'd like to explain the why there is a risk engine in this whole thing. And I'm going to start by analogy to what we do, and that is trying to explain how a hedge fund works. It is a bit like a football team in a way. So a hedge fund has the guys who score, which is the ones that kind of take the trading decisions. In jargon, like in Darwinex jargon, this would be you guys, and it's called like the front office. The front office is there, it's trying to win, and there's two ways to winning. One is punting, which is great in the sense that depending on how the incentives are aligned, I'm sure you've seen several, I mean, even banks go belly up because the guy out the front basically played a game which was, okay, I'm just going to punt, and if it flies, I'm going to make a mega bonus, and if it doesn't, then too bad, because I'm not a shareholder in this thing, so tough luck. When it comes to a hedge fund, it's pretty much the same thing. You have the front office is making the trades, and then of course at the back of that there's the investors, and the investors are the ones that are risking their capital. And obviously, when punts go well, then everything is good. But if you punt sooner or later, the thing is going to catch up with you, and you just blow up. You blow up investors' money, so the trader of course doesn't blow up, and that's why the way hedge funds are organized is you have the front office that takes the risks, and then there's the middle office, which controls to make sure that investors live to see another day. Okay, so that's roughly how it's organized, and there's a separation of roles in terms of making sure that the traders risk, but not more than they're allowed to or supposed to, because if that happens, then obviously the fund has lost the credibility, has lost the investors, and that's it. Now, when it comes to us collectively as Darwinex, what we're trying to do here is do something which is quite hard, which is to attract investment capital to managers that are unproven. So you go ask to an investor, would you trust a so-called retail trader with monies, and they'll just basically just leave the room in panic. So when we go out there to pitch the credibility of Darwinex, we need to produce risk-adjusted returns, because the investors will just look through any punts which are not on a controlled basis. And B, we need to do that in a way that's trustworthy, which we do by having an arm's length risk management system, which basically boils down to setting the trade sizes by the investors at arm's length from you. And the result of that is that you can think of Darwinex as you managing this virtual hedge fund, where you are the front office, and there's a middle office, which is called the risk engine. Right? So that risk engine is there to protect several parties. The first and most obvious party is obviously the investors. The second obvious party is Darwinex, because we are the ones facing the investors. And if something goes belly up, then it goes badly. But the last party, and that's the one that's perhaps less obvious to it, is like it's protecting each of you from everyone else of you. Okay, because I'm seeing here Sammy, and Sammy's kind of worked really hard to produce. I don't know, just hopefully don't take it wrong from me. So Sammy's worked very, very hard to produce risk-adjusted returns, and he has attracted. We have attracted investment for Sammy. So obviously, we want to make sure that Sammy's investor doesn't go wrong. So we protect the investor, we protect ourselves from any issue that Sammy might do. But then we've got Kieran at the same time. And he's also got investment via Darwinex. Okay, he's got a portfolio made up of Sammy and Kieran, and there's no risk engine. So what happens if Kieran loses the plot? Any answers? You guys are shy today. Okay, so if Kieran loses the plot, then the investor is going to lose their trust in obviously in Kieran, but also in Darwinex. So he'll pull the plug on poor Sammy, who's been working very hard to get the investment, and now he's lost it. Not because of his own fault, it's because of Kieran's fault. Okay, because we're all in this together. Investors will lose confidence, yes. I mean, like one thing is investors. There's two things that can happen here. One is investors know they can win and they can lose, but they want to know just how much they stand to lose. And if the trader does something which is outside of what investors expected to see, then yes, they will lose confidence. So it's not about winning or losing, it's about losing confidence. And that brings us to kind of the concept of risk. Okay, so I'm trying to sink that in, and hopefully that gives you a framework. Mind you, these things I don't test with Kieran in advance. So Kieran, anything that just where you think this guy, I lost it?
No, I like the fact we don't test it because I hear it for the first time as well. Like, because I come from a trader background like everybody else in the audience. So always hearing you're very matter of fact with things when the way with the way you talk about things, because you come from a background, or at least this is my read on how you answer questions and talk about things. You talk about things from a very matter of fact perspective, whereas a trader has their own bias to whatever the topic may be when it comes to trading, but you kind of stand outside of the circle of thinking, well, my risk is like you don't have the blinkers on, if that makes sense. I don't know if I'm making sense when I say it like that, but
yeah, no, like I'm looking at this from the outside in. I'm like,
yes,
full disclosure, I'm sure I've told you guys, I'm not a trader myself. Never was, never will, because I just don't have the I think it's the kind of the mental stability to kind of be at the expense of something that's outside my control. But that that's for everyone to have their own thing. And then also I've just got a company that it requires attention. In general. But the point is, the risk engine or the what a hedge fund calls the middle office is there to protect the investor interest at arm's length from the front office, who might have their own agenda. And their own agenda is they make a bonus when things go well, but they don't pay back client losses if things go badly, which is pretty much the same arrangement that we've got here with our Nexus. If things go well, you make a success fee, and if you don't, don't owe anyone, but then of course you might lose the investors. So that's the way it's set up. And then in setting it up, this creates trust for the investors. It creates trust for the regulators, because the regulators want to make sure that a regulated asset manager like us has processes in place. And it creates trust between the traders. So this is kind of a matter of creating trust. Okay? Somebody who's independent of everyone else here is doing their own thing at arm's length from everyone else. And the beauty in that is that if an investor trusts Darwinex and a trader trusts Darwinex, the trader and the investor may not know each other, but by virtue of trusting Darwinex, they have come to trust each other. And it's actually a beauty in that, because one of the beauties in the model is that if you, when you come to Darwinex, you will only ever face one investor, and that investor is Darwinex. Contractually. Okay, of course, we will be facing a lot of other investors, which we will have attracted, but they will only have trust in the model if they say, okay, there's something to protect me in case the trader goes belly up. And also because all of the traders here are competing for the same capital pool, then that also means that we need to create a level playing ground or level playing field. Because otherwise, how can we compare Sandy's returns with Kieran's returns? Okay, so there's two elements to the risk manager, and that is to A, control the risk of the traders, and B, is to level the playing field. That's the two things that it does. Now, I keep talking about risk, but what is risk? Anyone? I'm talking at like the highest possible abstractive level. Well, I like the Gazeba says opportunity. Okay, that there's something in it that I like. What you're willing to risk, win or lose. Yeah. Risk of losing money. So I think I'll just start at a more. I mean, it's a bit of a trick question, right? So, so I'm just going to go with it. So risk is the unknown. Okay. And the unknown is something in the future whose outcome you can't predict with certainty. So I think we all agree that no one here knows what's going to happen with our next trade. As a matter of fact, no one here knows what's going to happen with the trade that's already open. Right? It could go up, it could go down. We don't know. Right? Okay. So and this might be, I might be getting into more contentious territory. So does the fact that you started this trade and now you're at a profit or a loss change anything to what's going to happen to this trade going forward? This one's key. I'm just going to give you guys time. Depends on what's, does it depend, Callum? So you've got this trade which you opened today at 8 o'clock. It's winning or it's losing. You know, what's going to happen next? Do you guys know? So Callum, I'll just kind of take you further. So Callum, you said depends. Does it depend on the fact that you're up or down since you opened the trade? I'm just going to jump ahead. I think it does, because if you knew, then you would have a winning trade, and you don't know yet. I mean, obviously, it's a name. Of course. So okay, that's what we get. So Callum is saying, so market structure news could play a huge part. Yeah, lots of things could play a huge part, and the trick is, what is the difference between something certain and something which is random? Because random will mean different things to different people. So if you have a guy who has, you know, a PhD in astrophysics, we look at a star and we go, well, this is kind of random. I don't know which way it's going. The guy actually does know. So to me, it's random. To him, it isn't. So to me, market structure is random. To you, perhaps, hopefully, it isn't. Because if you figure out market structure, then you can make sure that this next trade, which is partially unknown, you've got better odds of winning than you have of losing. Okay, but all that is in your beautiful trader head. For me, as an investor, I have no freaking clue. From my standpoint, what I know is my money is in my account and it's moving according to this trade that you've placed. And I want to know, long term, I want to make, you know, obviously I would like to know that Callum has an edge because he understands market structure, and therefore, in the long run, the trades are going to go in his favor, and he's going to make money, and I will make money, and I'll be gladly paying him for it. But over the next month, I have no clue. And what I do know over the next month is that if you just kind of go for a punt and it goes badly, I'm going to lose my money. Okay, so in the long run, the odds are in your favor. In the short run, it's all kind of pretty much random. Okay, and then for me, what matters is, yes, I want to make money in the long run, but I certainly don't want to lose money in the short run. And if I see that I'm losing more money than I thought I was kind of, if I see that my money is moving by more than I signed up for, then I'm going to lose trust. So let's say somebody told you they want your investment to put into the S&P 500. And the next day they tell you they're up 50%. What do you guys think? Well, I mean, it would spook the living shit out of me, because if somebody tells me my money is invested in the S&P 500 and they've made 50% in one day, that person's a liar, because the S&P 500 has not made 50% in one day. Yeah, I'm just kind of being trying to be contentious here. But the point is, as an investor, I want two things. I want to know how much money, how much my money, so a range, yeah, so Karen will say a range out of 10% a year, they will be thinking what's going on. And what's going on is that you don't know the risk that you're investing in. And that because you know it's the S&P 500. But the problem is, if I'm investing in Kieran, I have no idea what Kieran is. Is he high risk? Is he low risk? I just have no idea. And how can I control what he's doing for me? Well, what I can do is I can appoint an algorithm to basically say, okay, algorithm, go figure out the way Kieran has been trading over the last 2 years or the last period or whatever it is. And tell me if Kieran was a random monkey that sort of traded with his position size in the assets that he trades and so on, by how much could my money move over 1 day, 1 week, 1 month, 1 year? Again, a random monkey. Okay, it's just that if you put a random monkey to trade, let's say Kieran trades, Bitcoin for hours per trade, 50 trades per month, and he levers up 2 to 1. So you put a random monkey to trade with the volatility of the Bitcoin in the way that Kieran just said, and the random monkey is going to come back to you as well. Every 10,000 months, then 95% of the months he will make plus minus this, and then most of the time he's going to make something in that range. So I will not know if he's a winner, but I will know roughly what can happen if he's a random monkey. Because a random monkey, I mean, do you guys agree that it's as hard to make money on purpose as it is to lose money on purpose? Does any of you know how to miss the next possible 10 trades? So you know how to miss the next 10 trades? You let me know. I'm just going to take the opposite of your trades and I'll get rich. I love to see you guys typing and kind of thinking. That's good. They're going to points that engagement. But the idea here is, as an investor, there's two things. I want to see long-term returns. And in the short term, I want to know what the worst possible outcome is. And in the case of trading, what drives the uncertainty, the risk going forward, is really those 4 things that I mentioned. Is how big is the position size relative to my account? How volatile is the asset that I've placed that position size in? How long I keep my trades open? And how many trades I place. It's those 4 things. And the only thing that risk engine does is it doesn't care one hoot what you trade. it doesn't care one hood how long you trade it, as long as you trade it like the normal way. I mean, basically, it doesn't care one hood because what it does is like, okay, how risky is in this uncertainty space, the key-run strategy relative to the S&P 500 or the W5 strategy relative to the S&P 500. And what it does is just it takes your trade sizes and scales them in a way such that they're both equally uncertain over a 1 month horizon. And why is that? Well, because we want to reassure the investors, like if you're investing this thing, then your risk is roughly, so over 1 month, the probability that this moves is about the same as if you had invested in the S&P 500. And that way, I have anchored my expectations of risk as an investor, so I know, okay, this is what I stand up to win or lose. I mean, roughly, that's kind of what could happen. If I want to have a lot of risk, then I invest more. If I want to have less risk, then I invest less, but I know how much risk I'm taking. So to kind of, whilst you're writing and thinking and agreeing or disagreeing, but obviously I'm not saying here I'm like the no of anything, but I'm just trying to kind of bring out the kind of truths which are indisputable. And I think the future is uncertain. And when it comes to trading and the way you guys trade, I mean, I think the future does not necessarily have anything to do with the past. And especially if I'm an investor that knows nothing about what's going on here, I have to assume that the only way to influence you, to control you, is to control the trade sizes. Because by doing that, I can bound my uncertainty. Here, and be quiet for quite some time, so like I try and speak for the audience.
I mean, I'll just let you carry on, Juan, because you like I say, you bring a different element to what most people are used to. You touched on a really interesting point though, when you said that the future and the past, they don't really align. Like you can't use the past as a judgment for what's going to happen in the future. I mean, I suppose you can to a degree, but it's still not an accurate measure. So one of the things that I was going to ask you is why drawdown isn't an effective measure of risk of a trader, right? Because I get asked this question on a daily basis.
That one's quite easy. So what do you need to calculate that drawdown?
That's data.
There you go. So it's like it's a bit like trying to gauge the risk of an accident by looking at the rear mirror.
Yeah.
Without looking at the speed meter. Or knowing which road you're driving. I'm going to make an even more stark analogy, okay? So here's this guy who plays Russian roulette. Okay, Russian roulette, I think you guys all know what it is, but it's basically you've got this revolver and you put, there's some bullets in it, and then you turn the kind of what's it called, the drum, and then hope for the best and you click the button, okay? So here's this guy that's done that 500 times and he's still alive. What is his risk taking the next turn? So, I mean, I think we all agree his drawdown is zero, right? Because, he's done this 500 times, he's still alive. So the drawdown is zero, okay? So what is the risk on the next thing? Gonna make it easy for you guys. So there's 6 holes in the drum. And it's random and it's not tricked and so on. So, it's a fair, like the drum turns the proper way and so on. So what is the odds that he's dead over the next thing?
It's 1 in 6, right?
1 in 6. Everybody agrees it's 1 in 6.
1 in chambers.
The 6 chambers. I mean, that bit again as the 6 chambers. I love people thinking on this one. But for start, I mean, like just that once you're thinking, I mean, let's recap, okay? So the drawdown is 0, and no one is saying that the risk is 0 going forward. That's already a start, okay?
Mhm.
So Antonio has divided 1/6 and come up with 16.66. And Callum he's done some math wrong here, but just check that over. So like if there's 6 chambers, it would be 1/6. For gazebo. So this is like a most of the ball of this go for the classic 1/6. Okay, so you've got okay. I'm just gonna tell you guys that you're all wrong. Okay. Who told you there's only one bullet?
Yeah, that's right.
Right? Okay. So in the analogy of a trader, it's like, okay, well, you just don't know how many bullets he's putting into the revolver. So for me to know what the risk is of the next row, I need to know it is a revolver, it is a fair revolver. There's 6 holes, so there's 6 things in the chamber. But I also need to know how many bloody bullets that he's put in it. If I don't know that, then would I play Russian roulette in that game?
I would hope not.
No. Yeah, I would not. I mean, like not for all the money in the world, right? Like it's just not going to happen. So that's that kind of so. Why is the concept of drawdown thing is because the fact that he's alive doesn't mean jack shit. The next thing, because you don't even know what the past draws were. Maybe he's been trained with like no bullets, and then occasionally he puts in 6 bullets, and then he doesn't take it. And you just don't know. It's played for free. Okay. So, but I think I mean I'm trying to put the kind of so the past is not a good predictor of the future. And the probability of something in the past is not a good gauge necessarily of the probability in the future. In any case, the most important thing is the risk is in the future. So that's to start with. And trying to use the past to predict the future only holds to the extent that the same conditions that held in the future hold going forward. And that's not assured because the trader can change his trade sizes at any point in time. He can change the assets he trades at any point in time. This trade that he normally held for an hour, he's now kept it going for like 10 days. And we all agree more can happen in 10 days than can happen in 1 hour. And so on and going forward. So Senderhart is making a very, very good point, which is to say the past is the only data we have, which is what brings us to the risk engine. Okay, so to make this thing generate trust, you need a history of what's happened in the past and an independent third party that reassures you that the conditions that applied in the past continue to apply in the future. Okay, so Senderhart, if I told you, yes, the guy has been surviving for quite some time, but someone else comes to tell you, yeah, this is a revolver. The drum is like the chamber is fair. It's not kind of rigged in any way. And the trader has only ever put 1 bullet. And let me take it one step further. He plays Russian roulette 20 times only per month. Okay, so we bound, we don't know what's going to happen, but we've put in a boundary around that so that somebody who's going to play the game going forward says, okay, well, I know which game I'm playing. And the only way to get the guy to play Russian roulette is you need to tell them how many holes are there in the chamber, and how many bullets you put in there, and how many times he's going to have to play per month. And that's really what the risk engine does. It's a way to define a probability range in the near future to live for long enough to figure out whether the trader really does have an edge. So Senderhart is saying, would I play roulette if the gun had 100 chambers and 1 bullet? As well, it depends what you pay me to make it how desperate I am, right? So, but then I know, I mean, if I know the gun has 100 chambers and 1 bullet, then I will already know the odds of this, is this worth my while or not? Is this worth my life or not? I mean, this is a bit of an extreme one, but I only know that if there's 110 chambers and 1 bullet, and I'm only going to play it once. So Callum, you're gonna play it. Well, for €1, would you play that for €1? I mean, I might play it for 1 trillion. I don't know, like maybe, but not for €1. 100 billion. Okay. Well, everybody's got their price, right? I mean, that's kind of the risk thing. So that's a personal thing for people to be choosing. But the point here is like you need to understand that probabilities that something happens, and that way, okay, if I know the probability that it goes bad, then I can try and see if the probability that it goes well times the money that I make when it goes well, whether that makes sense. But it only works if I know the risk, what are the different outcomes and what is the probability of each different outcome. And that's why we do the whole value of risk thing. Okay, so I think if you've understood the concept in terms of looking at what could happen going forward, then you can basically say, okay, well then, as an investor, show me the past data, which is what Senderhard is saying. Okay, show me the past data and see, okay, let's see if this guy really has an edge by playing this thing because he's survived for longer than the odds if this was just random. Which is why also, by the way, the length of a track record is important. Because maybe he got lucky 1 month, maybe he got lucky 2 months, maybe he got lucky 6 months. But if he continues playing in a game where the probabilities are known and he continues winning, then he's not a random winner. So to figure out if a trade is good, you got to give it time controlling the experiment, which is the whole risk adjustment bit that I mentioned here. Okay, all that to say that, to succeed at Darwinex Zero, what you have to do is manage a virtual fund, knowing that someone is going to control the experiment so that after enough rounds of Russian roulette, you're still coming out on top. That's maybe because you really know how to tell if there's a bullet in it or not, and you walk away from them. And meanwhile, for as long as that happens, until that happens, I want to know that my money will survive to live another day. And it's okay to lose, right? It's okay to lose, it's okay to win. That's not an issue. So let's go back to the investor of the S&P 500 thing. If somebody comes back to me and tells me, well, he made 1% or lost 1%, well, that's fine, because I know it was the S&P 500. But I need to know. Otherwise, I don't trust. And if I don't trust, I don't invest. So Sandy was asking, can we ask more specific questions? Yes, by all means. If I can answer, I will. And if I don't, if I can't, I will tell you too. That's why I'm here. Again, I think I'm done kind of lecturing you guys and stuff. Wow. So we're talking to a pro here. So he likes the value risk model, but it's based on a normal distribution and financial that has high kurtosis. Does this affect the VaR model? We don't really use the VaR model. What we do is we try and construct a distribution of what would happen in the future if we control the trade sizes as in the past. And we look at even the symmetry and asymmetry of what's going on. So for instance, if you have this loss aversion concept, which looks at the maximum favorable and adverse excursion of your trade, then the odds are that when you let the run through, it's going to kind of run further down than when it goes up. But really, what we're looking at is basically the trade sizes. The trade sizes they should be in line with what you've normally done. If it is, then that's fine. If it's not, if you're kind of going to trade out of whack in terms of trade sizes or trade frequency or trade holding periods, then the risk engine will start to gradually adjust downwards. I'm sorry because I managed to catch this cold.
I've got to say, I think the revolver and the Russian roulette analogy is probably the best the best analogy
I
I've
kill you
heard.
guys. I kill you guys. I shot you guys with my revolver. Yeah.
But I think it highlights. It's one of my favorite words now when I'm talking to people about risk is exposure, and it's more about like to me risk. And this is after conversations with you, Juan, and the session last week, and you know what how the way you talk about risk. But to me, I'm starting to see risk as it's more of just a broad general concept that doesn't really have much meaning. Whereas to me, exposure is how willing you are to, like you say, get shot to make a return. And that's why I
Yeah.
think that the revolver analogy is I'm gonna steal that one. I'm gonna use that every
Yeah,
week.
it's the exposure, right? Like because the exposure drives the likelihood of a certain outcome.
Mhm.
So yeah. So I guess he was asking, does the risk engine take into account experience time when calculating risk? Uh, so I mean, the risk engine is really a calculator, and what it does is like, given the way Gazebo typically trades, this is the range of trade sizes that are allowed. For as long as you stay within that tolerance range, it's not going to do anything. You can gradually change the way you trade, so it will gradually adjust the scale factor, but otherwise do nothing. And then the more experience it has, I mean, it takes a while until it's got enough experience to basically figure out, but at some point, it just looks back at a certain time window. So what you did, what you did 15 years ago doesn't really matter. What matters is, I think, I will have to get back to you with the details, but it would be like the last 2-3 months, and I think it's actually weighted in average in a way such that the most recent activity takes higher weight than the more distant past. So I think to answer your point is it takes into account experience. Experience helps up to the point where you reach the first kind of look back window, but once you are within the, it just looks back at the look back window. Okay, so Castillo, you're at 0.74 after 7 months with small drawdown. So what that means is like 0.74 means it's neither good nor bad. What it does mean though is that you're taking, and again, I'll regret saying this word, but you're taking less exposure or less position sizes than the leeway that you granted. So to compensate for your return, we'll basically scale it up by 1 divided by over 0.074. Okay, so basically what it'll do is it'll increase your return, it'll increase your drawdown by about 33%, meaning the ratio of 1 divided over 74, which is 4/3. So that's how it works. And in doing so, it will level the playing ground because here and here you keep trading with a 7 multiplier, which is 10 times as much risk as you, and he will get geared down by a factor of down to 14%. Senohard, is there any advantage to having a low or high multiplier? What do you think, Senohard? Hope you can answer it, Kieran. It's funny to.
Oh, no.
Oh, Senohard, it's better to have a low one. No, it doesn't really matter. It's going to get scaled one way or the other. What does matter, and this really is important, is that you try to keep, to the extent that you manage to keep that multiplier as constant as possible, what that basically means is there's going to be a one-to-one correlation between the signal account and the Darwin effect and the Darwin performance. So Gazebo, the one thing it cannot do is make mediocre traders get better results. That it cannot do, because what it's doing is just like scaling the trade sizes, but it's not changing the trading strategy. So it's not hard. I think the important thing about the multiplier, it doesn't matter. The level is completely irrelevant because it will get scaled away. What does matter is to try and keep it reasonably constant, which means whatever it is you're doing, if you're changing the exposure, which you might do by trading more volatile assets, by holding on to trades for longer, by levering the trades more, or placing more trades, those are the 4 dimensions, then it will change the multiplier. And if you do that suddenly, then the more sudden the changes, the bigger the correlation breakdown. Very good question by W5. Does the risk engine change the lot sizes according to different strategies if the trader has multiple strategies? And the answer is it will consider all the strategies as a combination. It will learn about the patterns, and to the extent that the trade sizes within the different strategies are consistent, it will do nothing other than scale. Hope that makes sense. So, by the way, I'm loving the fact that some of you guys have an owl and animals in there. I think you're kind of joining into the whole thing. I used to be a lion, more of a lioness these days. Actually, I'm not even. Is the camera even on?
No, not at the minute.
So that's the toll it takes on you. But I kudos to the ones who are picking animals. So guys, we recently talked about a trader who made more money with a risk modification than he would have made without it. I mean, that's basically. We always look at this from the standpoint of the investor. And the investor, remember, he's been promised a risk similar to the S&P 500. And everybody gets treated the same way. Some guys get scaled back, some guys get scaled down, but that doesn't really matter for the investor because all the investor ever sees is the Darwin. So here's the question for you guys. Whilst I'm here, like this is the most loyal guys. What would you think? So for starters, we're planning on launching an index to track the best Darwins in the platform. Okay. So what would you guys think if we gave you the option of getting paid the success fees in participations in that strategy as opposed to cash? You could always redeem the cash, but would you be interested? That's a mouthful of the question. Yeah, repeat that. Okay. So let's say, where do we want to take Darwinex? So I mentioned the risk engine is there to protect the franchise, including all its components, against rogue traders. So let's say Darwinex going forward was a prop owned by its traders. Meaning whatever money everybody made was reinvested into the best traders. And the more money we made, the more capital we would invest in each other. So if that was the case, would you be open to being paid your success fees in shares in that prop? I can see the humming, right? I can see new people writing, which I love. Aaron requested to speak.
Let me.
By the way, guys, I'm not saying you would always have the option of taking the cash. By the way, yeah? This is not. I'm not saying it's something that we would force on anyone. Your cash is your cash. It's hard earned, and you deserve it. Like there's no question that your cash is there, and we're good for it. But if given the chance, because the thing is, good traders, I think, the more money we make, the harder it will be to scale the good traders. So there's a value to. Sorry, I'm just going to go and I can't take it. Okay, that was just like a thought out there. It's something we're thinking. I mean, I think the broader idea is to basically create a token that will be basically invested in the best traders. The company and the founders and so on will invest in the best traders, and so could you if you wanted to. And yes, by the way, this doesn't mean we're trying to kind of steal the money. No, yeah, you made some cash. I said you made some cash. It's your cash. You get to choose what you can do. But one privilege is to be able to invest in the best traders in the platform. We'll talk about that going forward. But I think my dream would be for Darwinex to be a community where everybody gets the opportunity to back the best possible strategy in the platform. And the first people who should get the privilege of investing in the best traders should be the traders themselves, the winning traders. But that's for another day. More on that if there's enough traction and we see enough interest. I think, Ali, the point is invest in the best trader. I think the best trader is not one trader, but 80 traders, because they're all doing different things. And then one guy could be doing well, the other could be doing badly, but as a collective, they will be stronger in the long run than the individual traders. Yes, they will make less money because of the diversification, but then if we can always gear up the capital. And that's the interesting thing about this one is that in that index strategy which we launch, €1 invested by an investor is actually €10 of risk capital that the traders get to enjoy. Meaning each euro of cash that you redeploy in the platform comes back as €10 of risk capital into the platform. And you get to make money too. Anyways, we'll explain that in due course. That's for now it's an idea, but it's one that I think is gathering increasing traction inside of the company. We're looking at ways to make it happen. And for me, it would be like a dream come true because that way Darwinex would be managed and owned by its traders. For its traders. And that we know we can talk about kind of scamming and this and that and next. This way, we will be scamming ourselves. If you think it's a scam, then you want to be at the other end of it. So might as well just go for it. So, meaning, if you think if you're on the losing side of a scam, then that basically means there's a winning side of the scam, and you can be on either, which means it's fair. It's a bit like when you've got a brother and you've got a donut and you got to share about two. And I think the best procedure is to get your brother to cut it, as long as you get to choose the first piece of the two as well. So it's a bit like that's the concept. Okay, well, I hope that wasn't too much of like a digression. I think hopefully the messages are basically risk is something that happens in the future. The past is only a good predictor of the future if the rules haven't changed. And you need someone that ensures that the rules haven't changed so that you can extrapolate from the past into the future. And that somebody is called a risk engine in Darwinex, which is there to create trust amongst all the participants, starting by the investors, but going on from the trusted by the investors in Darwinex and the trust by the traders, the individual traders in Darwinex too, because hey, if Sami's making a lot of money because he's granted more exposure, then he's cheating over all the others. And we're basically the referee in the whole thing. And don't you worry, curious for, you will get your money all right. It's okay. If you prefer to take the cash, then it's great. Bear in mind, at some point, Warren Buffett didn't take any more cash. So the thing is, you'll be able to use the cash for as long as it's there, but you'll not be able to reinvest it. And maybe one day you'll not be able to buy the top traders. But that'll be the luxury problem, which is not what we've got today. So it's a good choice. I agree that ownership builds stronger communities. Yes.
Yeah.
Because people talk about alignment. I think there's no better alignment than not being alignment because one is already aligned with himself. So it takes two to align, but if it's just one, there's no need to align. It's just you. Okay, so I think that's enough for a Wednesday afternoon. Sounds by the sounds of it. I hope you didn't you got your money's worth for attending today's session. And if there's any questions that you've got, I'm sure you're in touch with Kieran, so I will try and tackle the different topics as they come up. Hope this got you thinking at least.
Yeah, I mean, if the retention in this session has been pretty much 100%. So clearly people have enjoyed listening to you talk about risk and your, your perception on it. So if there's any other topic that you want us to do in these sessions moving forward, like just DM me or ping me in the chat. And then Juan and I can have a conversation and we can come prepared with, again, like today, with ideas of what we want to kind of talk about and explain. But I've got this session recorded as well, so I'll speak to the marketing department and see if we can get it uploaded onto YouTube. But if you want a copy of it before that, which hopefully I can get done tomorrow anyway, but if you want a copy of it before that, just ping me a message and I'll send it to you via DMs as well.
Yeah, and last but not least, I mean, I think it's kind of sneaky for me to ask, but if you guys like this, the way to grow this one for everyone's benefit is to spread the word. So if you can let others to know that this was interesting, and perhaps even use your what's it called, this member gets member thing that gets you and the people that you invited something. I think the bigger Darwinex is, the more value we can offer to all the investors. And I mean, ultimately, what this is a community that's pooling a subscription to get investors for the best of them. And the more people are in it, the faster we're going to grow the capital for everyone else. So, yeah, and thank you, Gazebo, for mentioning and so on. I know you guys already do, but like the only way we have to grow is this one, because unfortunately we don't make thousands of euros by scamming people into bullshit. So, yeah.
All right,
okay,
guys.
well, thanks so much, guys. It's always a pleasure. I really enjoy these sessions, and then you hear and you let me know what we can do, and to the extent you think this brings value, I'll be happy to continue doing it.
Awesome. That's perfect. Thank you for coming on as always, Juan. And I mean, it definitely brings value. Like I say, you bring a fresh perspective to every trader and everybody who maybe sometimes struggles to understand certain intricacies of Darwinex and Darwinex Zero. So I think these are very, very solid. And I mean, Sender Hearts just said it's a very good presentation. I kind of like it like this, where it's just you talking and people listen, rather than always having a presentation or a webinar, because sometimes people get lost in that. So like I say, I'll get this uploaded to YouTube, and if you want a copy, just direct message me and I'll send you one straight away. So thank you all for turning up. If you've got any ideas for the next one, or for one in a couple of weeks' time, just send me a message and I'll be sure to speak to Juan and we'll see what we can do. Guys, have a fantastic evening and great rest of your week, and I'll speak to you all later.
Take care, everyone. Thank you so much.
Bye bye.
Always a pleasure. Bye bye.